In an era where financial independence is a growing priority, many investors are turning to dividend-paying exchange-traded funds, or ETFs, to generate passive income. One standout option is the Schwab US Dividend Equity ETF, or SCHD, which has become increasingly popular for its strong performance, attractive yield, and reliable payouts. But can SCHD actually replace your income? The answer is yes, if it's approached with the right strategy and expectations. SCHD is designed to track the performance of the Dow Jones US Dividend 100 Index, which includes 100 high-quality US companies with a strong history of paying and growing their dividends over time. These companies are screened for their financial strength, dividend sustainability, and profitability. What sets SCHD apart is its combination of a respectable dividend yield, often between 3.5 to 4.5%, and the potential for capital appreciation. Its low expense ratio of just 0.06% makes it an efficient, low-cost option for investors seeking income without sacrificing their long-term growth. Let's break down how SCHD can replace your income with a practical example. Assume you want to replace $40,000 per year in income. If SCHD yields 4% annually, you'd need an investment of $1 million in order to potentially replace your income. So a $1 million investment in SCHD could potentially generate around $40,000 per year in dividend income, assuming stable distributions. This income is generally paid quarterly, meaning you'd receive about $10,000 every 3 months. Importantly, this does not require you to sell shares, meaning that your principal remains intact, unlike the traditional 4% withdrawal rate where you draw down the portfolio over time. Why does SCHD stand out from its competition? The first reason is its dividend growth. SCHD has consistently increased its dividend over years. This helps your income keep pace with inflation, a key advantage over fixed income assets like bonds or CDs. The second reason is its quality holdings. SCHD holds top-tier companies like Pepsi, Coca-Cola, and Merck, stable, profitable businesses that tend to outperform across economic cycles. The third reason is tax efficiency. Dividends from SCHD may be considered qualified dividends, which are often taxed at lower rates than ordinary income. This can enhance your after-tax return, especially in a taxable account. And lastly, liquidity and flexibility. As an ETF, SCHD is highly liquid, and you can buy or sell it at any time during market hours. There's no need to manage individual stocks or worry about stock-specific risks. Replacing your income with SCHD isn't just about overnight results. It's about long-term planning and consistent investing. Here's how you can make it work. Firstly, you can start early using tax-advantaged accounts like Roth IRAs to accumulate SCHD shares. You can reinvest your dividends until you need the income. Reinvesting dividends will accelerate the growth throughout compounding. And stay consistent. Dollar cost averaging into SCHD regardless of market fluctuations to build your position over time. And lastly, monitor the yield and expenses. While SCHD is low cost, staying informed about its current yield and distribution expenses ensures that your income plan stays on track. No investment is without its risks. SCHD's income is definitely not guaranteed, and it can fluctuate with market performance and the dividend policies of its underlying holdings. Additionally, SCHD is reconstituted every single year, which can affect the dividend income. Also, during bear markets, SCHD's price may drop even if it continues to pay dividends. Diversification and a financial safety net remain essential. The Schwab US Dividend Equity ETF, or SCHD, offers a compelling path forward towards financial independence by providing a steady stream of income through high-quality dividends. With proper planning, it can replace a portion or even all of your working income, especially for those who prioritize reliability, simplicity, and long-term growth. By viewing SCHD as not just an investment but an income-producing asset, You can create a self-sustaining portfolio that works for you, one quarterly dividend at a time. We're going to go deeper into the long-term strategy, realistic timelines, risks, and reinvestment math, and even the retirement planning tactics that are centered around SCHD. So whether you're in your 20s, 40s, or even your 60s, this guide is going to show you how to turn SCHD into a true income machine. Reinvesting your dividends is one of the most powerful tools in long-term wealth building, and SCHD makes it easy. When you reinvest the quarterly dividends instead of spending them, you buy more shares. More shares means more future dividends, which buys more shares, and so on. This is called the snowball effect, and over a decade or two, it can massively amplify your portfolio. Let's say that you invest $100,000 into SCHD and it yields 4% annually. If you reinvest those dividends and assume an 8% total return, dividends and capital appreciation, your investment grows like this. After 10 years, it grows to $215,892. After 20 years, it grows to $466,096. And after 30 years, it grows to $1,006,266. Now, after 30 years, that $100,000 that you initially invested is throwing off over $40,000 a year in dividends. That's enough to replace a moderate lifestyle's worth of income. While replacing your income sounds attractive, no investment is perfect, and SCHD isn't without its risks. There's a risk of dividend cuts. While SCHD holds quality companies, dividends aren't guaranteed, and economic downturns or company-specific issues could lead to cuts. There's also market volatility. SCHD, like all equity-based ETFs, can experience price declines. It's not a substitute for a stable bond ladder or savings account. There's also sector exposure. SCHD tends to be concentrated in sectors like industrials, consumer staples, and healthcare. It's diversified, but it's not immune to sector downturns. And it's also vulnerable to interest rate sensitivity. As interest rates rise, high-yield equity ETFs can underperform as investors shift to bonds or treasuries. And if you want to mitigate these risks, you can diversify into other ETFs or income-generating assets. You can keep a cash reserve to avoid selling during market downturns. And you can use tax loss harvesting in a taxable account to offset market gains. Dividends are often taxed, but SCHD has some favorable traits. Many of SCHD's payouts are considered qualified dividends, which are taxed at 0%, 15%, or 20% depending on your income bracket, not your ordinary income tax rate. Roth IRA is the best place to hold SCHD if you're planning for a tax-free retirement income. And traditional IRAs or 401ks are good for deferring taxes until later in retirement, though the withdrawals are then fully taxed. And just a regular brokerage account is best if you're in a low tax bracket or using the ETF for early retirement. Consulting with a tax advisor can help you optimize your withdrawals and reduce taxable income in retirement. Retirees used to rely on bonds for stable income, but with interest rates fluctuating and inflation eating away at fixed payments, SCHD has emerged as a modern-day pension. It provides rising income with dividend growth that combats inflation, equity exposure with the potential for capital appreciation, liquidity, it's easy to sell if you need to, and transparency, you can see exactly what you own. In contrast to annuities or pension plans, SCHD gives you control, flexibility, and the option to leave your portfolio to your heirs. Replacing your income with the SCHD ETF is not a get-rich-quick scheme. It's a decades-long journey of discipline, reinvestment, and strategic planning. But for those willing to stay the course, SCHD offers a straightforward, proven way to build passive income streams from America's most reliable dividend-paying companies. With the right mindset and timeline, you won't just be buying an ETF. You'll be building a freedom engine that sends you a paycheck every single quarter, even when you're not clocking in anymore. If you enjoyed today's video, please be sure to hit the like button and subscribe to the channel in order to stay up to date with the latest videos from the Financial Freedom Show. Feel free to comment down below if you're adding SCHD to your portfolio. Love to hear from you in the comments. And thanks for watching. I'll see you in the next one.